Okay, let's unpack this. You've given us a really interesting set of financials for a company, and we're going to dive right in.
Yeah, looks like a good one.
Based on everything you've shared, the company we're zeroing in on today is StarBucks, ticker SBUX.
Ah, Starbucks. Okay.
And our goal here really is to figure out if this, huge coffee chain is its financial health actually as strong as its brand presence.
It's a great question. And what's interesting, just looking initially, is how much data we actually have here.
Right.
We've got profitability, cash flow, all of those key ratios, margins, debt levels, even valuation and dividends, stock performance too.
It's pretty comprehensive.
Yeah, it gives us a lot to work with. Should let us get some real insights.
Exactly. So our mission for this deep dive is basically to sift through all this, find the most important bits, and understand, based on these numbers, how healthy is Starbucks right now? And maybe what does the future hold?
Sounds like a plan.
So where do we start? There's so much here. I think let's go with the absolute basics first. Are they actually making money consistently?
A good starting point. And, well, the data makes that pretty clear.
Yeah.
Yes, they are.
Okay.
Starbucks shows consistent profitability, positive earnings in the past year, strong operating cash flow too. And what's really notable is the history.
The track record?
Exactly. They've kept this up, profitable, positive operating cash flow for the last 5 years straight. That suggests a pretty stable, reliable core business.
Okay, so profitable, check. That's fundamental. But how well are they using what they've got? Their assets, the capital invested, that's where we get into efficiency, right? ROA,
Right.
ROIC.
Absolutely. Those tell us how good they are at turning resources into profit. Let's take return on assets, ROA. It's 9.89%.
Which sounds okay, but what does it mean in context?
Right. The number itself isn't the whole story. Compared to their industry peers, that 9.89%, it actually beats over 85% of them.
Wow, 85%. So they're really good at squeezing profit from their assets. Maybe it's the brand or how they run the stores.
Could be a mix of things. Strong brand loyalty definitely helps. Maybe efficient operations too. But yeah, generating nearly 10 cents profit for every dollar of assets and doing it better than most competitors is
It's pretty strong.
Yeah.
Definitely. Okay, so what about the other one? ROIC, return on invested capital. What's that angle?
ROIC looks even stronger, actually. It's 15.79%.
15.79. Okay.
So this measures how well they generate profit from all the money invested, equity, and debt. And again, comparing them, they outperform nearly 83% of competitors here.
So consistently beating the competition on efficiency.
Yeah, and what's interesting too is their ROIC, looking back 3 years, it's been higher than the industry average of 14.25%. Suggests, a sustainable edge in how they use capital.
Okay, now this is where it gets really interesting for me. If that ROIC, the 15.79%, is higher than their cost of capital, their WACC, does that mean they're actually creating value? Not just profitable, but value adding?
Precisely. That's the key test. The cost of capital is like the minimum return investors expect. If your ROIC is higher, like Starbucks seems to be, you're generating returns above that hurdle. You're making your investors wealthier, essentially.
Right, creating real economic value. That's huge.
Absolutely. Starbucks is clearly in that value creation zone based on this metric.
Okay, super important insights. Now, let's zoom in a bit on the margins. We've got profit margin, operating margin, gross margin. What are these different layers telling us?
Right. So the profit margin, the bottom line, is 8.61%. That's how much of each sales dollar turns into net profit after everything.
And how does that stack up?
It puts them in the better half of the industry, actually. Outperforms over 70% of peers. But there's a small note here. It has dipped a bit recently.
The slight decline. Any idea why from the data? Costs going up, competition getting tougher?
The numbers themselves don't spell it out, but yeah, a falling profit margin usually points to pressures like that. Something to keep an eye on.
Okay. What about the operating margin?
That one's looking a bit more stable. It's a decent 12.12%. This focuses more on the core coffee shop operations, before interest and taxes.
And compared to others?
It outperforms over 61% of the industry, and crucially, it's held steady lately.
Okay, so even if the final net profit felt to squeeze, the core business itself is still running pretty efficiently. That's good to know. But the gross margin, that one seemed weaker.
You picked up on that right. The gross margin, 25.03%, is where they seem to lag. A full 80% of their industry peers do better on this measure.
80%. Wow. What does that usually mean?
It typically suggests their direct costs, the coffee beans, milk, cups, the labor making the drinks, are relatively high compared to their sales price.
So maybe less efficient sourcing, or maybe they just pay more for quality ingredients.
Could be either, or both. But it's worth noting this margin has been relatively stable itself over the last couple of years, so it's not like it's suddenly collapsing.
Okay, so not a crisis, but maybe an area where they could find some efficiencies down the line.
Potentially, yeah.
All right, let's switch gears. Let's talk debt and risk. Sounds like some positive news on that front.
Yeah, a few encouraging signs here. First, they've reduced their shares outstanding. Fewer shares now than last year, and even fewer than 5 years ago.
Which is usually good for existing shareholders, right?
Go.
Most EPS.
Generally, yes. Also, their debt-to-assets ratio has improved compared to last year, so they're relying a bit less on debt relative to their asset base.
Okay, less leverage. Good. Now, what about this Altman Z-score? It's 2.64. Sounds a bit technical. What's it telling us about bankruptcy risk?
Right, the Altman Z-score. It combines a few ratios to predict financial distress. Basically, under 1.8 is high risk, above 3 is low risk. Starbucks at 2.64 is kind of in the middle, the gray zone.
Gray zone, so not totally safe, but not flashing red either.
Exactly. The risk isn't zero, but it's not an immediate major worry. And interestingly, this score is actually better than almost 3/4 of their industry peers.
So relative to others in their sector, they're actually looking pretty stable from this perspective.
Relatively speaking, yes.
Okay. And their ability to actually pay the debt back using the cash they generate. That debt to free cash flow ratio of 5.63.
Yeah, that ratio tells you, theoretically, how many years of free cash flow it would take to pay off all their debt.
So about 5.5 years for Starbucks.
Roughly, yes. And what's reassuring here is that this is better than over 78% of their competitors. So they seem to have a pretty decent capacity to handle their debt using the cash the business throws off.
Okay, so the debt picture seems, reasonably well managed overall. Maybe that Altman Z is just a slight caution flight, but nothing alarming compared to peers.
Seems fair.
Now, let's look at something that does sound a bit more concerning based on the numbers. Short-term health. Those liquidity ratios, current ratio, quick ratio, they don't look great on paper.
You're right to flag those. The current ratio is 0.64.
Which is below 1. That's usually not ideal, right?
Correct. A ratio below 1 suggests they might have fewer current assets like cash, receivables, than current liabilities, things due within a year. It could indicate potential difficulty meeting those short-term obligations.
And how does that compare?
They underperform over 64% of their industry peers on this one, so it is a relative weakness.
Okay, definitely something worth noting. And the quick ratio, it's even stricter, excludes inventory. The data mentioned both 0.45 and 0.64. Bit confusing.
Yeah, that's a good spot. There seems to be a slight inconsistency there in the data provided.
But either way.
Right. Either way, whether it's 0.45 or 0.64, the story is similar. Both suggest a potentially tight situation for covering immediate liabilities without needing to sell inventory quickly. And the data says, using either figure, they perform worse than over 71% of their peers.
So profitable long-term, but maybe some near-term cash management focus needed.
It certainly looks like an area they might need to manage carefully, yeah. Bolstering short-term flexibility could be important.
Okay, got it. Now, what about actual performance trends? Earnings, revenue? Seems like a bit of a mixed bag recently.
That's a good way to put it. In the last year, earnings per share actually saw negative growth, minus 6.76%.
Ouch. After positive growth before.
Yeah, it contrasts with the average growth over the past few years, which was positive, around 3.70%.
And revenue?
Similar story. Revenue dipped slightly in the last year, down 0.5%, minus 0.50%. Again, that's after a period where it was averaging growth of about 6.4% per year.
So a recent pullback on both the top and bottom lines after a period of, slow and steady growth.
Pretty much, yeah, a recent dip.
But the future estimates look way more positive.
They do. Analysts following Starbucks are projecting quite strong growth ahead. They expect average annual EPS growth of 14.35% in the coming years.
Wow, 14.35% average annual growth. Yeah. That's a big jump from the recent negative number.
It is, and they also expect revenue growth to pick up again, projecting an average of about 7.83% annually.
Okay, so analysts are clearly expecting a rebound or some growth drivers to kick in. What could be behind that optimism? New markets, cost cuts finally working, price hikes.
It's likely analysts are factoring in a combination of things. Maybe continued international expansion, perhaps seeing those margin pressures ease off, success with new products, digital initiatives driving sales, lots of potential levers.
Right, lots of possibilities. Okay, so a potentially brighter future, at least according to forecasts. Let's talk valuation. What's the price of admission to own SBUX stock? Those PE ratios look kind of high,
They do seem a bit elevated, yeah. The price-earnings ratio is 26.14.
meaning you pay about 26 times last year's earnings per share.
Exactly. Now, context is key here. That's actually pretty similar to the industry average PE. And it's also not far off the S&P 500 average, which is around 24.85.
Okay, so maybe not cheap, but not wildly out of line with the market or peers.
Right. And the price-forward earnings ratio, which looks at expected earnings, is 23.56. Also considered somewhat expensive, but again, it lines up reasonably well with the industry and is maybe a bit higher than the S&P 500's forward PE, around 20.89.
So the market seems to be pricing in that expected future growth we just talked about.
That's typically what a higher valuation like this implies, yes. Investors often pay more when they expect strong future earnings growth.
Makes sense. So expensive, but maybe justified if the growth comes through. Now, what about income investors? Dividends. They seem to offer a decent yield.
They do. The yearly dividend yield is 2.97%. That's a pretty respectable income return.
Okay. And we should probably note the stock price dropped quite a bit recently, minus 23% in 3 months. That pushes the yield up, right?
It does, mechanically. A lower price means the same dividend payment represents a higher percentage yield. But even considering that, the data suggests their yield is competitive.
How competitive?
Well, it's better than over 84% of their industry peers. The industry average yield is around 3.52, so Starbucks is up there. And it's also a bit better than the S&P 500 average yield of 2.40%.
Okay, so even with the stock price drop factored in, it's still providing a solid dividend compared to many others.
Yeah, they're returning a good chunk of cash to shareholders.
All right, so let's try and pull this all together. We've gone through profitability, efficiency, debt, liquidity, growth, valuation, dividends. Quite the journey. What are the main takeaways if you're trying to get a handle on Starbucks' financial picture?
Okay, synthesizing it, I'd say you've got a company with a really strong base of profitability, excellent returns on assets and invested capital, that ROIC being above cost of capital is key, showing value creation.
Solid fundamentals there.
Definitely. But there are some pressures. Margins, especially gross margin, are lagging peers, though operating margin is holding up okay.
Right.
Debt management looks better recently, though that Altman Z-score puts them in a sort of watch category, even if they're better than most peers. The big caution flag seems to be short-term liquidity. Those current and quick ratios look weak.
Yeah, that stood out.
Recent growth in earnings and revenue dipped negative, but the future projections are very strong, especially for EPS.
Right. Big expectations there.
Valuation looks kind of pricey, but it's roughly in line with the market and the industry, likely reflecting those growth expectations. And finally, they offer a pretty attractive dividend yield.
Okay, so it really is a mixed bag, isn't it? Strong core, creating value, good dividends, but facing some margin headwinds, liquidity questions, and a valuation that relies on future growth delivering.
That sums it up well. Strengths and challenges.
So here's the final question, really for you, the listener, to think about. Given Starbucks' solid profitability and that strong projected growth, how do you weigh that against the current high-ish valuation and those potentially concerning short-term liquidity numbers? What factors do you think will be most crucial for Starbucks pulling off that growth and succeeding in the next few years? Definitely something to mull over, maybe with your next cup of coffee.